DNA, the Metaverse Dual Chain Network Architecture.
Hi, I'm Alex Lightman, and this is the Lightman Report. And today we're going to talk about the past, present, and future of savings. This is part of a four-part historical overview, past, present, and future. It was suggested by my friend and colleague Annemieke Derkes, who lives in the Netherlands. And she asked me for this, so I'm going to do as she asks. If you have suggestions for a show, please feel free to send it, and I will see what I can do about that. Past, present, future, savings. So in the past, savings included salt, gold, silver, shells, precious shells, and precious stones and metals. One of the more interesting forms of money were the big, giant stone wheels of the Yap Islands in the South Pacific. And we also had gold, silver coins, and jewelry were actually the most common forms of coinage. And we also had land, buildings, slaves, and cattle, including in Africa by the Maasai warriors. And still today, your wealth is determined by how many cattle you have. And for ancient civilizations, the first financial institutions were parts of temples. Many temples held nobles' money and treasure and were involved in banking and activities, and priests kept track of deposits and of loans. So the priestly class was actually the money class. And some of our first records are financial records and records of inventory, and which was a form of wealth. So we actually created writing in cuneiform in order to keep track of financial records, basically what we call the books. And if we look now at the dollar versus gold, we see that this ancient power of gold. Like, why did the ancients use gold? Well, because it keeps its purchasing power. And there are studies that show that gold, in terms of the amount of bread and eggs that it can buy, has maintained its purchasing power across 5,000 years. That's pretty interesting, because there are some people who think, well, if it lasted for 5,000 years in the past, it'll last for 5,000 years in the future. I don't know that that's true, but let's dive in and see what happened during the last 100 years or so. Actually, the last 115 years. So gold has offset the loss of purchasing power of the US dollar. The dollar's lost 98.2% of its purchasing power since 1900. Gold has increased 53.9 times in value in dollars during that time. Therefore, 1.8% times 53.9 equals 97% of the purchasing power has been retained by gold. And so you can actually see this curve, this graphic here, declining near. This is the collapse of the US dollar as it goes down, 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 down. And you can see gold going up, up, up. They don't go up and down at the same rates. They're not completely correlated, but overall, gold maintains purchasing power better than dollars. And now, so we're now going to look at the savings and banking in the 20th century. So this is a graphic of bank failures per year. And each line is 500 banks. So the top of the graph is 4,500. The peak year for banks collapsing was 1933, and when 4,000 banks collapsed. And then you see another cluster, tiny cluster of banks happening from 1935 to 1939. You see a lot fewer banks collapsing after the inauguration of Franklin Delano Roosevelt, who used to be the governor of New York. So, of course, he was very familiar with banks and Wall Street, and they supported him. So the Federal Reserve Bank is a relatively new institution. It was set up in 1913, and it was given the right from Congress to operate for 100 years. And in 2013, that 100-year certificate was renewed without any debate, which is bizarre, but it happened. And in 1922, there were 30,000 banks around. Many were undercapitalized. 1933, we had deposit insurance introduced. So people had to pay a little bit, but they had their deposits insured. Now you want to talk about an FDIC-insured bank. So some are not. But they will supposedly pay you in case the bank collapses. And you also have a highly fragmented system. So you normally had to have all your banking done within one state. And you had the first interstate banks only allowed 1976. And we see in this graphic that we have these clusters of banks. So between 1981 and 1993, we had the savings and loan crisis. And then also, of course, 2008 to 2013, we had a number of banks fail. And we will probably have a number of banks fail as a result of these COVID shutdowns as well. So we have a big shift and difference between global savings rates. So if you see that spiky thing at the top, that now I'm a little bit colorblind, but basically that top one is Japan. So Japan has been hovering around 20% savings up to so in 1962, Japanese savings was about 20%, and it went around from about 1968 to 72 at the time of the OPEC oil crisis. It hovered around 20%, and then it spiked up to 24% savings rate, which is pretty phenomenal. And then it's been going down, 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 down. So in 2008, it came down to about 3-4%. And then we also see the United States. The United States is another kind of spiky, thick line. It's this one right here. And that's started off around 6-7%, and then it's just gone a little bit up and down, but then it's crashed to being around just before the savings and loan crisis, an effective savings rate of about 0. So it's very, very hard to have plentiful capital low rates sustainably if you pay almost nothing to people. And right now, interest rates are 0. Banks are in the Netherlands and in other places are charging people to store their money there. So there are big disincentives to savings, and overall, the rate of savings has fallen. And then if we look at fiat for savings, fiat currency, every one of them is potentially a bubble. The currency only has value because people believe it has value. And there are plenty of examples of plenty of historical examples when the faith was lost. Now, that whole chart there that starts with Angola or Argentina and so on up to Zimbabwe shows the highest daily inflation. So we start with Angola, 2.1% daily inflation, Argentina 3.7%, Armenia 1.9%, up to Zimbabwe, 98% daily inflation. That's quite a lot. And you had daily inflation 2007 to 2008. There are trillionaires. Many of my friends have $1 trillion Zimbabwe dollar notes. And you have Russia with 4.2% daily inflation between 1992 93 when the collapse of communism and state-owned enterprises were being sold off. And in the Democratic Republic of the Congo, around the same time, you had 4.3% daily rates. And as you can see, there's practically the whole alphabet of countries have had this kind of hyperinflation. It's not even a rare phenomenon. So we talk of financialization and decades of financialization. That's a term economists use to describe the growing scale, profitability, and deregulation of the financial sector relative to the real economy. This is what happens when you allow banks to become too big, too speculative, and too opaque. You can't see their books. You don't really know what they're doing with the money in the years leading up to the financial crisis. Economist Thomas Philippon has counted the total compensation of financial intermediaries, profits, wages, salaries, and bonus, as a fraction of GDP, and he says it's at an all-time high, around 9% of GDP. Now, during the Roaring '20s, the highest that financialization got of the economy, and remember, this crashed and it led to the Great Depression, that was a maximum of 4%. And if you see these poor husband and wife in the cartoon, they're carrying the house and their house payments and the mortgage and the bank and Wall Street, and the Wall Street banker that they're supporting says, hey, it's all holding up just fine. But with all these people unemployed, unemployment spiking to 50 million people, I think that 50% of all the renters in LA County, where I live, are not making their payments or have missed payments or not making any payments since the COVID crisis. And so we now see all the percentage in that graph in the lower right. We see basically financial services. Look at what percentages for insurance, for securities, and for credit intermediation. Now, all of this can be taken care of through digital assets and cryptocurrency with no human beings involved. That's basically this. If we really get crypto right, we have 9% of the whole GDP to play with. And the US GDP is about 82 trillion, or at least it was in 2019. I'm sorry, that's the global gross global product is 82 trillion. And then we have in the United States about 21 trillion a year. So 9% of 21 trillion, that's about $2 trillion. That's quite a lot of money that's there for the financial services that could go back to the people if we went full on crypto and digital assets. So the first period of early financialization lasts from the beginning of the 20th century up until 1933. And the New Deal brought significant changes in financial regulation and policy orientation, as we saw with the banks really just falling off, this whole collapse of all the banks, which is part of why FDR got elected. And the second period, 1933 to 40, reflects the transitory phase of the economy that leads to the third period. And then we have what some have called the golden age of capitalist development. 1945, the end, the victory of the Allies in Europe and Asia over the Axis powers of Nazi Germany and militarist Japan, Italy, Hungary, Romania, Bulgaria. Those were the last three nations the U.S. ever declared war on back in 1942. And the crisis of 1973, when OPEC embargoed the United States and the Netherlands, heralded the end of the golden age. And then if we apply Dumenil and Levy's definition of neoliberalism as financialized capitalism to link the fourth period of complex financialization with from 1974 to 2010. And then we also can see that the wages and salaries as a percentage of gross domestic product has gone from a guns and butter peak of 52% around 1970, 71 or so. Then we had the energy crisis, we had stagflation, we had the financialization boom, we had the internet boom and the housing boom. And pretty much, except for the internet boom, earned income as a share of GDP has declined regardless of the macro situation. The demand for labor only spiked higher in the dot-com boom, and to a small extent, basically after the last financial crisis, it went up just a little bit to go there. But if you see that massive decline, you can basically say that as financialization goes up, then wages and salaries go down as a percentage of GDP. You can't have financialization be at an all-time high and then have wages and salaries not be going down lower and lower. So that's your choice. Do you want higher wages and salaries and more equality, or do you want more money for Wall Street? It's pretty much the choice we have to make. So let's look at the size and the scale of the financial instruments. The stock markets are worth about $89 trillion as of April 2020. They'll probably be a little bit higher now because the people are a little bit more optimistic. The narrow money supply is about 35 trillion. Broad money supply is about 96 trillion. Global debt is 252 trillion. Global real estate is 280 trillion, though I've heard it's more than 300 trillion, some numbers. And global wealth, it's about $260 trillion. Of that, about 103 trillion is the worth of the United States as a whole. About 3 trillion is the worth of Russia, just to put this in comparison. The derivatives market the market value is about 11.6 trillion. But the notional value of these derivatives, showing but their ability, if they're all executed and you actually bought or sold that would be 558 trillion. And the notional value at the high end is about $1 quadrillion or more. And if you look also at the world's money and markets, we see that Bitcoin is $159 billion. Digital assets as a whole, that's all the cryptocurrencies and digital assets, are about 250 billion. And the FANG, Facebook, Amazon, Apple, Netflix, Google, 3.883 trillion, so just under $4 trillion. It shows their absolute power to influence our economies and our government. And then we have the US dollar M1 money stocks. That's also about $4 trillion. The Fed's balance sheet, 4 trillion, 4.1 trillion. It's probably more than that now. Gold market cap's about 9 trillion. The M2 money stock is about 15.5 trillion. U.S. public market cap stocks, about 30 trillion, 30.4. U.S. bond market cap, about 54 trillion. Global stocks, 84 trillion. This is a slightly different time period than the stock market. It goes between 80 and 90 trillion or so. And then global debt, 253 trillion. So we see digital assets here are very, very tiny, and yet they can recreate and change all the rest. So if we look at wealth levels, current results of our savings in 2019, the median wealth per adult in US dollars, we see that basically when you look at median, so that top number, that the darkest color there, which you have in Canada, you have in France, you have in Australia, you have in New Zealand, the median wealth per adult in US dollars is 100,000. So that means per person, half the people are above 100,000 in New Zealand and Australia, and half the people are below. And the United States is slightly less than that, between $50,000 and $100,000. And then you have, and that's the case for most of the rest of Europe. And then you have Eastern Europe. You have between $10,000 and $25,000. You have Africa. Basically, most of Africa is below $7,500 in savings as a median. And so we can kind of get a sense of where the money is. And as you can see, it's in North America, it's in Western Europe and Northern Europe, it's in Japan, it's in Korea, and it's in the antipodes, Australia and New Zealand. And then if we look at an asset class comparison, what are the good things about real estate versus commodities, everything? So the good parts of real estate are there's low levels of correlation with other asset classes, and generally real estate keeps up with inflation, but it can be illiquid. It can be hard to sell a property. So as a result of the protests and riots in Minneapolis, in the last weeks before this one, 1 week after the riots, 17% of all the homes in Minneapolis were put on the market for sale. So it can be very challenging to sell a home when 1 out of every 5 people who are in your neighborhood are selling their home at the same time, because there's probably not going to be a 17%, a massive increase in demand right now. And that's why basically it's really important to have your city government, have people feel they're safe, because they'll leave and they'll take their tax payments, which are used to pay schools, with them. Also, high yield and emerging market bonds. There's a diverse asset class. It can provide higher yield and inflation protection, but it's riskier than government bonds, but it's less risky than equities. And then if we look at alternatives, alternative finance, low correlation with other assets. They have a variety of drivers and return characteristics, but because not as many people have them, because they're not listed on exchanges, they can be illiquid and can be complex. And then commodities have a low correlation with equities. They're a hedge against inflation, but they don't have natural income, and they can be very volatile, and you can lose money, as we'll see. And cash, there's no capital loss. It's highly liquid, but it's typically a low return, and the value is eroded by inflation, as we just saw from all of those daily rates of hyperinflation in Zimbabwe and Democratic Republic of Congo and Armenia and other places. So equities historically outperform cash and bonds, and they benefit from economic growth. Good economic growth means really good performance in the stock market, typically. But the volatility can be high. You may have an overall thing across 10 years going up, but when you want to get it in a certain time of a day, you can lose money. I saw a young man was using Robinhood who's 20 years old, and then all of a sudden he was writing options, and he was writing puts. And he opened up his account and he saw he had a $720,000 loss. He was in the negative, so he had a bigger loss than that. And he killed himself because he was so unhappy about it. So you have to be very, very careful about equities. Government and investment grade bonds, they're less volatile than equities, and they have stable income delivery. And historically, the returns lag the equities. The returns are driven by interest rates. That's basically, if interest rates go down, that can be helpful, because if interest rates go down, the government bonds go up because they're paying a higher interest rate than you would get from fresh new debt. And then Bitcoin is volatile, but in 2010 to 2020, it outperformed all the asset classes. So you see here, in this upper left graph, you see U.S. fixed income was about 5% on average for the whole decade. All global equities were about 7%. Large global equities were about 8-9%. Small global equities were about 10%. And then you had venture capital was 1% to 10%. Growth equity was about 10%. Real estate is a big range. It's between 3% and 12%. Natural resources were about 4% to about 18%. Distressed securities are somewhere in the range between 5% and 12%. That's where two members of the Trump cabinet, they were specialists in distressed assets. And buyouts were about 5% to about 20% or so. And if you look at the average annualized volatility, Bitcoin is 125% annual volatility. So it's basically the price is changing more than 100% per decade. And the S&P 500 is 13%, gold is 15%, global equities 18%, U.S. Treasuries 3.8%, global Treasuries 2.8%, and U.S. dollar to the euro 9.6%. And if you look at the average annualized return, we see Bitcoin during the decade of the 2010 to 2020 had an annual return of 370%. S&P 500 did 14.7%. Gold was 1.2%. Global equities 10.8%. U.S. Treasuries 2.5%. Global Treasuries 3.4%. Commodities lost 7.9% per year on average during the whole decade. Coal did especially bad. Coal was a disaster for people. U.S. dollar versus the euro is minus 1.2%, and U.S. dollar to the Japanese yen was 3.5%. So in the 2020 crisis, is Bitcoin a defensive asset? And in the future, we can look at DeFi as a savings method. So decentralized finance markets can be much more effective than traditional savings, and you have popular DeFi services such as MakerDAO and Compound. And we have an earlier Lightman report all about this, about DeFi. They offer passive incomes to their clients. So the percentage of buys or deposits, that they're exactly the same as the $1,200 stimulus check. You see them spiking hugely. So people just took their their check from COVID and just stuck it into these kind of accounts. And then if you see what would a $10,000 investment in mid 2020 be? Well, it would be worth $6,600 for commodities. It would be $7,000 for yen. It would be in the Malaysian ringgit. It would be 7.4 thousand. Euro at 8,000. Silver 8,000. Gold 8,000. Euro 8,000. Silver 8,000. Gold 9.9. So about 10,000. So gold is maintained. Didn't go up much. Didn't lose much. The yuan about 10,000. Pretty stable. U.S. dollar index 10,000.7. Bonds 12,000. S&P 500 25. But a Bitcoin would be, if you put $10,000 into it in mid 2010, that would be worth $201,553,333. That's a hell of a return. That's the greatest return of all time for the decade. And I predicted in the mid-decade that it would be the best performing investment of the decade. It was pretty easy to see back then, but still it was predictably good. And then if we look into the future, we see billionaire Tim Draper is investing in DeFi Money Markets DAO, Digital Autonomous Organization, and the DMM protocol, as an example, is a bridge between Ethereum digital assets and real-world assets. And according to their announcement of the company, the DMM protocol is an interface that lets anyone earn 6.25% versus 0 for many bank accounts, backed by real-world assets. And it's it's a pretty interesting option. So if we look at the evolution of money, we see barter to gold, to metal coins, to paper money, to plastic cards, to electronic money, to cryptocurrency. It's part of the whole evolution of money. And then finally, last slide of this Lightman report, crypto works when there's war, instability, and chaos. We've seen that. So Bitcoin helped people survive in Venezuela and Zimbabwe. And people use crypto to overcome currency and capital controls in times of volatility in the BRICS countries, Brazil, Russia, India, China, South Africa. And in 2020, the whole world is becoming a big chaos zone. Peter Zeihan in his books has predicted this whole collapse of the world order. And crypto has a great chance to become the last argument of kings. Of course, armaments is what used to be the last argument of kings. But crypto can be that for savings in turbulent times when the global order could be rewritten and states could be falling right and left. And as they said from my previous favorite show, Game of Thrones, Tyrion said just now, kings are dying like flies. So I hope that you've enjoyed this summary of the past, present, and future of savings, and that you give a try. Put some money into a DeFi account and tell me how it goes. Thank you for your time, and I'll see you in a future Lightman Report.